Okay, we're going to go ahead and get started. I would like to welcome everyone to Financial Reporting. We have a truly collaborative event today. We have Nicole Hruban from the SCORE Northeast Massachusetts chapter assisting us. I'm Teresa, I'm from the Boston chapter, and this webinar is being brought to you by the East Cambridge Savings Bank. They asked us to put together a series of webinars to help the clients that they see coming through, and we're happy to work with them and bring this to everyone today. So I want to just start with a little bit of intro about SCORE. We do, like I said, work as a collaborative group in our district, which is the state of Massachusetts and Rhode Island. You can see a couple stats there about SCORE. The most important thing about SCORE, the things you need to know is that we offer training, which through webinars, we offer fantastic websites for you to access that have all kinds of templates and different videos you can watch and presentations you can watch and just instructional material that you can access to help you along the way on your path to business ownership. The most important thing that SCORE does is its mentorship, and our mentors are volunteers that come from all different backgrounds and experiences to help people that are in the I'm thinking about starting a business to I'm in the process of starting that business to I need to grow my small business. And, you know, we're thrilled that our volunteers can help you along that pathway. The nice thing about SCORE is we are a national organization and we can go to that database of volunteers should the need arise if we can't help you at the chapter or district level. So you might be asking, how do I get a mentor? Very easy. You can put a note in chat, and I will make sure the right chapter contacts you to get you set up with a mentor. You can go to our websites, and I will put those in the chat right after my intro. So you couldn't be easier. Today, we do expect a decent crowd. So we are going to be using the Q&A tab. It allows me to not lose track of questions that are being asked. Any question that you put in Q&A will be what's asked out to the presenter. Definitely use chat for everything else. That's not a problem, but if you want a question asked to the presenter, please use it in that Q&A feature. We are recording today, and I will post the link to where you can find that recording so that you can watch again if you need to. So I'm going to go ahead and turn it over to our presenter, and I want to welcome Nicole Hruban. It's all yours.
Thank you, Teresa. Hello, and thank you for joining me today for this financial reporting webinar. This session is intended sort of as a high-level overview of what's important in financial reporting and how those reports come about. And hopefully we can build some comfort with financial reporting, and we'll put you in a position where you can have relevant conversations with your accountant or your bookkeeper, or give you just some food for thought. So let's start with a quick overview over the agenda. So we're going to start out with a little bit of why financial reporting is important, what it actually entails, or what it is, when you should do it, and how you should best go about it. So let's start with the why. Why should you do financial reporting? Well, there's a couple of reasons, and I listed them here briefly. The first one is to evaluate your operations. So financial reporting can actually help you get an insight of how efficiently or effectively you are operating your business, how quickly you sell your inventory, how are your operations, so your day-to-day processes, right? Are they generating cash or are they consuming cash? All those questions, and there's many more, you can answer with financial reporting. It will also show you the financial state or condition of your company. And this is not only important to you, but this is also important to potential investors or creditors or anybody that can potentially provide capital to your company. They want to know before they invest how well the company is doing. And then when they are invested, they want to know how, what you did with their investment. The third reason is you can analyze your cash flow, because in the end, right, it's not the revenue that you generate, but the cash that pays your investors and that pays yourself, right? So you want to make sure that you have a good grasp on what the cash position or the cash flow in your company is. You can also plan or forecast and ultimately make decisions if financial reporting is done right. So at the beginning of the year, you can sort of project what your revenue and expenses are going to look like based on the different strategies or actions that you're going to take throughout the year. And then during the year, you can actually look whether those projections are met, and if they're not, you can adjust accordingly. And last but not least, you are required to do financial reporting by law. So the Internal Revenue Agency requires reporting or looks at those financial reports in order to determine your fair share for the taxes. So to sort of summarize it, if financial reporting is done right, you get a complete picture of your company's finances in regards to revenues, expenses, profits, capital, and cash flow. So let's get right into it. What is financial reporting? Typically, when we talk about financial reporting, we talk about 3 statements: the balance sheet, the income statement, or sometimes also called the P&L or profit and loss statement, and the cash flow statement. Sometimes you'll hear a 4th one, which will be the statement of shareholder equity. I'm not going to talk about that one today, but it's essentially a statement that shows how the investment of your shareholders develops over time. So we're going to focus on those 3 today. These 3 statements, and this is kind of what I try to graphically display here, are actually interrelated. So if I start from left to right, you can see the balance sheet at the end of 2020, right? And then again at the end of 2021. So the balance sheet is actually, you can think of it as a snapshot in time of everything that your company owns and everything that it owes and its equity. In between, one balance sheet to the next balance sheet, something is happening, right? And this is what the income statement and the cash flow statement will show you. And more specifically, the income statement shows you what happened to your equity from, or why your equity changed, I should say, from one time, so from the end of 2020 in this case, to the next, to the end of 2021. And your cash flow statement will show you why your cash changed from one point in time to the other point in time. So you can think of those 2 statements sort of as videos between those 2 points in time that will show you what's going on in those 2 very important accounts. And the income statement, and I tried to sort of graphically show this here, basically says or shows you for this equity change from one period to another, how did it come about? And it divides this equity change in revenue and expenses. Revenue increases, it will increase your equity. Expenses will decrease your equity. And the same thing with the cash, right? So the cash, this cash flow statement is sort of the magnifying glass that looks at this change in cash and divides your change in cash into 3 broad categories, namely the cash from operations, the cash from investing, and the cash from financing. So let's start with the balance sheet. So the balance sheet is a snapshot or a point in time of everything that the company owns, its assets, and everything that it owns, We call this liability, or claims that's that third parties or yourself have against those assets. The difference between what your company owns and what it owes is what we call shareholder equity, or owner's equity, or net worth or equity. And this idea or principle is very similar to, for instance, home equity, right? So when you look at the value of your home, that's what you own, right? Minus the mortgage that's outstanding against it, that's what you owe. The rest is really the true value that you hold in your home. Okay. So input for financial statements, what goes into financial statements? Well, financial statements are essentially recording in accounting each and every business transaction. And for each and every business transaction, this relationship here holds. So we call this the basic accounting relationship sometimes. So in that relationship says that assets have to equal liabilities plus equity. So the left has to be equal to the right. So what are your assets? Well, your assets are any resources or items of value that your company owns. It can be cash, it can be inventory, it can be land, equipment, buildings, but it also can be, so those are obviously tangibles, but it could also be intangible things, such as patents, for instance. Liabilities are the debts that your company owes to others. This can be to banks, for instance, or it could also be some kind of trade credits, right, that your vendors extend to you. And then finally, the owner's equity is the difference between those two. So now let's look how we can sort of build our financial statements based on that relationship and based on business transactions. And here, what I would like to do is sort of show you a couple of business transactions, and we're not going to go through all of those, obviously, but I'm going to pick out a couple, and then show you how those transactions sort of manifest themselves in the accounting and how this accounting equation holds. So let's start with Kira. So Kira opened a company called KnitWorld Inc. at the beginning of 2020. And as many small business owners, she invested some money of her own savings, in this case, $30,000. And she borrowed another $20,000 from friends and family. Then during the year, some things happened. Just to pick a few, for instance, she purchased furniture, fixtures, and equipment, $10,000 worth. And she also purchased merchandise. So what she's going to sell in her store, such as yarn, knitting supplies, books, and so on and so forth. She sold during that year, she sold $10,000 worth of product. And as it happens many times, not all of this was sold for cash, right? At the end of the year, $10,000 is still outstanding to be paid for by customers where that was sold on credit. She also pays herself some salary. She has a part-time help, and so on and so forth. So now let's look at how those transactions manifest themselves. Let's start with the first transaction here, right? So we said she invested $30,000 of her own and $20,000 from friends and family. So let's start on the left here, right? So what she owns, the $30,000, that's her own equity, right? That's $30,000. She has a $20,000 loan. And that gives her her beginning cash, if you so will, her beginning funds. So now when we look at this, right, this here is the asset side, right? And this here is the liability and equity side. So we have $50,000 in cash and $20,000 in loan and $30,000 in owner's equity. So this basic relationship, right, left has to equal right holds. And I could go down over each of those business transactions that I described on the previous slide, and it would always hold. So if I just pick the second one, right, where she purchases $10,000 in fixtures and furniture, we call that fixed assets, right? So we have $10,000 worth of fixed assets. And then we also have $10,000 of merchandise, right? So we have $10,000 in inventory, and she purchases this with cash, right? So the cash goes down 20,000. So minus 20,000 here, plus 20,000 here. So everything happens on the asset side. Nothing happens on the liability and equity side, right? So again, this the left, right, is 0 is equal to 0. So the left is equal to the right. And we can go down all of these transactions, and this principle will always hold. And this principle does not hold only over each of those individual transactions. It will also hold over the entire year. So basically, if you were to add up this column here, right, to get this total here, and then do the same thing for each of those columns, right, the totals that you get on the left side, remember this is the asset side, would equal the total of the right side. So this accounting equation, assets equal to liability plus equity, holds for each transaction and also over the entire firm. Okay. And so this is kind of just a quick intro to basic accounting, if you so will, because what we can do now, we can use this information to generate our balance sheet. And it's actually quite simple. If we started with the first 2 lines of the table, right, and summed those up, so those first 2 lines here, right, and let's assume this is our opening balance. We can basically just rearrange these lines to where those columns that we have here actually become the lines in a balance sheet table, and we can easily create 2 balance sheets. And this is kind of what I've done here. So you can see that, you know, the cash line, right? Cash is 30,000. That goes here on the asset side in like a balance sheet or in a T account. We have no accounts receivable, and we have inventory, right, of 10,000. So all of these items are what we call current assets. And current assets, you can think of it as any asset that can be turned into cash within a year. Okay, those are called current asset, or can be liquidated within a year. And then we also have what's called fixed assets, right? And this was our equipment that we purchased. And here we have 10,000, right? So we start with 10,000. If we add those 2 together, we have total assets of 50,000. And then if we look to the liability side, right, we can see that we have $20,000 in loans and 30,000 in owner's equity. So we have no current assets, right? Because none of those 2 comes due within 1 year. But we do have long-term liabilities that loan, and we have equity. So again, the total of that is 50,000. So again, left is equal to right. And then if we were to take that last line from the table of the previous slide, right, and again, create a balance sheet T table, right, we could basically add all of those accounts here. And this is what I've done. So again, this was the last line from the previous slide. So you see the cash is now 31,000. We have accounts receivable, we have inventory, and so on and so forth. And on the liability and equity side, you can see that I have some accounts payable. So that is where I received, for instance, merchandise, and I haven't paid for it yet. Loans, and our equity has changed to 36,000, right? So again, if you recall that graph that I gave you in the beginning, right? We noticed that the cash from one balance sheet to the other changed, right? It was 30,000 here and is now 31,000. And we also noticed that the equity changed, right? From 30,000 to 36,000. So now what we're going to do is we're going to look at the income statement and at the cash flow statement to figure out how this change came about. Let's start with the income statement. That's, by the way, is the second financial statement that we use for financial reporting. So the income statement, there is what I call a basic structure. You can be a lot more detailed here, but these are sort of the big ticket items, if you so will. So we start with the revenue. So this is, in her case, the sales that she made. It's $100,000. We subtract out the cost of sales, which are the cost of goods sold and any other costs that are directly related to sales. And what those are, I'll show you on the next slide. If we take the revenue minus those cost of sales, we end up with what's called the gross profit. If we then go ahead and subtract out what we call operating expenses, you'll sometimes see SG&A expenses, which is selling, general, and administrative expenses. So those would be wages, those would be marketing expenses, it would be utilities, it would be IT, and so on and so forth. That's all in here. And we would also include depreciation. Okay, so if we subtract all of this out from the gross profit, we get to what's called the operating profit. You might sometimes also hear EBIT. That's a very big number, or a very important number for many investors or creditors. Okay, so the EBIT is the earnings before interest and tax. Or we sometimes also hear operating profit. So if you take out from that number, then your interest expense, you're going to get to the earnings before tax, or EBT. If you take out the tax provision, so then the amount of taxes you anticipate to pay, you're going to get to your net income. Okay, so this is the general structure of your income statement. So now let's look at Midworld. So we said she had, the company had $100,000 in revenue. She paid herself salaries and also had some help. Now, I added this here under direct costs. If you notice, is above the gross profit. You can argue that it might have to go to other expenses, but there might be some relation to revenue, right? She might not pay herself as much salary if her revenue was smaller. Typically, what you would find here is, for instance, if you have a sales team, or if you have individuals that get paid on commissions, that's something that you would find here. We would also subtract out, our cost of goods sold. So the purchases here were $18,000 in this case. So if we subtract all of those, we get to a gross profit of 40,000. So the first thing that you can do basically when we generated that is you can now look at what's that gross profit in relationship to the revenue. So you take the 40,000 in this case and you divide it by the 100,000 in revenue. This is what's going to give you the gross margin. And in our case, it's 40%. So what does this tell us, right? Well, it tells us for every dollar that you earn in sales, 40 cents is available, right, to cover your fixed cost and your profit. Or put vice versa, 60 cents of each dollar that you earn is variable cost, okay? And this is actually something very important because what happens to a company that has a lot of fixed costs, if the sales go down, those fixed costs don't change, right? So you're going to have an issue because you can't reduce those costs as fast. Variable costs you can reduce a lot faster. So this is an important ratio, if you so will, to look at. Okay, so if we now take the 40,000 and subtract out the other expenses, utilities, rent, marketing, and so on and so forth, and the depreciation, we get to what's called the EBIT, right? The earnings before interest and tax. In this case, for her, it's $8,000. Then we take out interest payments. She had to pay $1,500 for the loan she got from friends and family, and we assume the tax provision is $500. So this is her net income. And again, what we can do is we can look at the net income in relation to the revenue. And this is what we call the profit margin. So in our case, it would be 6,000 divided by 100,000 gives us 6%. Or put it differently, 6 cents of every dollar she earned is profit. Okay. And as you note here, remember how I said this income statement is sort of the video that shows you how that change in equity came about? Well, if you recall, we started with $30,000 in owner's equity, and we ended with 36,000. So we had a change of plus 6,000. And this is how this change came about. Now let's move on to the cash flow statement. So again, the cash flow statement, right, looks at how that change in cash from one period to another came about. And we said we have 3 broad categories: cash from operations, cash from investing, and cash from financing. So let's start with the basics, or the cash flow in general, right? So the cash flow from, or the cash flow statement in general, shows the flow of cash in and out of your business. And that net change in cash, right, that 1,000 in our example, is the total of the net cash from your operating activities, from your investing activities, and from your finance activities. And I'm going to show you what those are on the next slides. So essentially, the cash flow statement is a tool that will help you to determine the short-term viability of a company, and particularly its ability to pay bills. Now, what's often happening, and I didn't include this here, but you will prepare, or your accountant or bookkeeper can prepare what's called a cash budget. So you will look at what is your cash inflow versus what is your cash outflow over the next week, 2 weeks, 3 weeks, 4 weeks, month, 2 months, and so on and so forth. And it will help you determine whether you have a short-term funding need, right? Because if you determine that at the end of, the next month or the next 2 months, your cash inflows are smaller than your cash outflows, you have to look at where you get that funding from, whether it's, reach out to your banker for an increase or an establishment of a credit line or whatnot. But you basically use that cash flow statement to make sure that your company is viable, or determine that your company is viable. So let's start with the operating cash flow. So the operating cash flow looks at whether your operations are generating or consuming cash. You can actually record all your cash inflows and your cash outflows, but it's very uncommon that it's done this way. Usually we use what's called the indirect method. And the reason is because you record all your business transaction in accounting, and they are recorded based on an accrual basis. So they're recorded when you make a sale or when you get a bill, right? Not necessarily when the cash for that sale actually comes to you, or when the cash for that bill that you have to pay actually leaves your bank account. right? So this is why we sort of have to generate the operating cash flow in an indirect way. So what we do is we take the net income, right, from the profit and loss statement. We add what's called non-cash expenses. So this is in our case, for instance, depreciation or amortization. We make some adjustments. I'm going to leave that to your bookkeeper or accountant to make those. And then we add and subtract all changes in current assets and current liabilities that are not considered investing and financing, right? And what I'll show you on the next slide what this would be for Knit World. And in the end, this is the net cash from your operating activities. So let's look at Knit World, right? We took the P&L, right? The profit and loss statement, we generated that. And we also have those two balance sheets that we generated in the beginning, right? So we said we have to start with the net income. So we would get that from our profit and loss. It was the 6,000. We would then add depreciation, which would be the 2,000. Okay. And then we said we had to add and subtract all changes in current assets and current liabilities. So let's look at accounts receivable, right? So we started the year with no accounts receivable, right? They were 0. But at the end of the year or at the beginning of the next year, the accounts receivable were $10,000, right? So they went up by $10,000. So is this what is this? This is really a use of cash, right? You used cash for this. Why? Well, because you made sales, right? You sold inventory, but you've not received the cash payment yet, right? So we have to subtract that. Okay. Same goes for inventory. On the other end, right, if we look to our liabilities, we can see that our accounts payable, so that's where we, for instance, have the merchandise already, right, but we've not paid the vendor yet, right? That would be in accounts payable, and we see that accounts payable increased. It went to $5,000. So for us, this is actually a use of cash, right? We basically had the product, right, already, or had our inventory or the merchandise already and have not paid for this. So this is why this has to be added. So again, if I add all of those up, I get to a cash flow of operations of $1,000. Okay. And then we said after the cash flow of operations, we need the cash flow from investing and financing. For simplicity, I assumed that those are 0, but I still want to sort of go through what the cash flow from investing is. So cash flow from investing essentially shows how much cash has been generated or used in investment-related activities. And those can be the purchase of physical assets, so property, plant, equipment, but it can also be investment in securities or the sale of the former, okay? Then we have what's called the cash flow from financing, and this is essentially the net amount of funding that your company generates. So it could be financing activity, could be the issue of new debt, whether it's a new bank loan, for instance, but it could also be, if it's a bigger corporation bond issue, the issue of new stocks. So if you decide to sell part of your equity to investors, then this would be a stock or share issue. Financing activities would also be the repurchase of your shares. So if you had shares outstanding, you could pay those shareholders money to purchase those shares back. It would also be dividend payments. So if you issued a bond, you would have to make if you issued shares, you'd have to make dividend payments, but you could also make payments on your bonds, obviously. And you would also have to make principal payments, right? So if you took out a loan, you would probably have to make some payments against the principal. So this would also be cash flow from financing. So let's just assume those were 0 for us, right? We add those 3 up. this is the $1,000. And again, if you recall, we started with $30,000 in cash. We ended with $31,000. So this change actually was 1,000, and this statement, the cash flow statement, shows us how it came about. So this is kind of how those three statements go together, but now we can work with these statements to find out a little bit more about our company. And we do this via ratio analysis. So it's basically, those are basically calculations to assess a company's financial health. And your lenders or investors are going to look at some of those ratios as well. So it might be a good idea to look at them for yourself as well, to just be aware of how your company looks in this regard. So those ratios bring out important information from those financial statements, and they can help you capture the profitability, the efficiency, and the liquidity of your company over time, and also in comparisons to other, because you could take those ratios and compare to others, in your industry. And what's important is whether a number, right, that you see is good or bad always depends on its relationship to other numbers. So this is why this ratio analysis is actually so important. So let me give you an example, right? If your company had a net income of $70,000, we don't really know if this is good or bad, right? If your sales or your revenue was $700,000 and you would have a net income, right, after that sales amount trickles down through your profit and loss, and you end up with 70,000, that would be a 10% profit margin. That might not be too bad, right? However, if you made $70,000 in net income, but you had sales of 7 million, right, then this profit margin shrinks to 1%, right? So it's always important to put that 70,000, right, in relation to other numbers, but also look at it over time and in comparison to others. You probably can find out, like, for your industry, what's a typical profit margin, what's a typical gross margin, and that's how you can gauge how you're doing in that respect. So there's three types of ratios. One's called profitability ratios. The other ones are efficiency, and the third ones are liquidity. So let's start with profitability ratios. This one is, you might have heard of this one already. This is called ROI, or return on equity. And it's essentially taking the net income and dividing it by your owner's equity. And this is really a measurement of how efficiently your owners, so the capital of the owners, right, or the owner's capital, so the capital of those who own a share in your company, is employed. The next one is called return on assets, or ROA. And this shows you the efficiency with which your company allocates or manages resources. So in other words, how much income can you generate with your assets? And profit and gross margin rate, we already talked about. So if we look at this for knit world, right, we can quickly calculate those ratios. We said the company had a net income of 6,000, and the equity, remember, it changed to 36. So the company's ROE is roughly 17%. So that's not a bad number. But again, we want to look at this over time, right, and potentially in comparison to others. The ROA, right, we would take, again, the net income divided by the total assets, and that's roughly about 10%. Again, look at it over time and in comparison to others. Profit margin and gross margin, we already talked about. Then we can also look at efficiency ratios, and those will be helpful for you to sort of assess how efficiently you're running your business. The first one is the asset turnover. That's a very broad one. You basically just look at your sales in relationship to your assets, and it will tell you how much dollars in sales can you generate from each dollar that you invested in your assets, right? This next one is the inventory turnover. So this is your cost of goods sold, right? Divided by the ending inventory. And this basically tells you how many times per year can you turn over your inventory. And you could actually take this number that you calculated here and, or actually take 365, right? Divided by this number that you generated here. And it will tell you how long your items or your merchandise is sitting in inventory before it gets sold. And this is very important because ideally, right, you want your inventory to turn a lot of times throughout the year, and you want to keep the time where your sort of your item is sitting in inventory or sitting on a shelf as short as possible. Then we have what's called the collection period. So here you take your accounts receivable. So that's the amount that's outstanding at the end of the year of where you've already sold the product or sold your merchandise, but have not received payments yet. And it's essentially the time between when that sale is made, right, and when the cash is received. And we want to keep that time as short as possible. And then finally, we have the payable period. Payable period is accounts payable divided by credit purchases. So this is the other side around. So how quickly you are paying your bills. And again, we can look at those for Knit World, right? If I take the inventory turnover, right, we have the cost of goods sold, the 18,000 from the income statement, divided by the ending inventory, which was 12, so 1.5 times she managed to turn her inventory during the year. Her collection period is 36 days, so that's about a month or a little bit over a month, and her payable period is 101 days. So this is obviously based on my numbers from the examples, but this would actually be a very favorable situation, right? Because you collect within a month, but you don't pay your vendors in more than 90 days. Now, obviously, there are no vendors that will allow you to pay in more than 90 days, right? But it kind of gives you an idea. If you can make this smaller and make this larger, right, you have a lot more cash available to you, okay? And finally, the liquidity ratios. So those will give you an idea of what it says, how liquid your company is. The general one is the total assets to equity, and it shows you how much of the assets is financed by equity. And then if we want to look at the liquidity ratios, those are down here. So this is EBIT divided by interest expense. So this shows you the number of time your interest was earned over a certain period. So this is obviously very an important information, right? Because your EBIT, your earnings before interest and tax, is what available or what is available to pay your interest expense. So you want this to be larger than 1, right? And then you have your current ratios, which is current assets to current liabilities. It shows you what can you turn into cash within a year versus what's due. And then we have what's called the asset test. This is a little more conservative because you take out inventory of current assets. And again, we can do this for Knit World and see that, for instance, the times interest earned is 5.33, right? So she earned 5 times more, right, than what she actually had to pay in interest. So that's good. That's also, good when you go, for instance, to a bank or to any type of creditor or potential investor, because it shows you that you can meet your interest. It shows them that you can meet your interest payments, right? Current ratios is also good. She has 10 times more assets that she can turn into cash compared to liabilities that are consuming cash, right? And the asset test is a little more conservative. It's 8 times more. Okay. So those are kind of information that, or ratios or information that's brought out by simply looking at different items of your financial statements. But financial reporting can also be, and I've mentioned this in the beginning, right, to sort of make decision on an ongoing basis throughout the year. And this is kind of like, when do you do the financial reporting, and how do you do it over time, right? So typically what I would suggest is that, when you start your company or at the beginning of the year, you kind of derive a plan for your profit and loss statement. And you think about, what are going to be, what kind of revenue do you project? And what kind of expenses do you project? If you project a 50% increase in revenue, right, because your demand is going up, you're going to have to think about how are your expenses going to increase with that. So at the beginning, I suggest, to come up with a plan of your financial statements for the year, right? And then throughout the year, you should do reporting. Reporting can be done on a weekly, quarterly, monthly basis. Typically, in a lot of companies, we do what's called financial reporting on a monthly basis. So each month you go and you look, how is your actual P&L, for instance, or profit and loss for this month, looking against your plan? And what kind of actions do you have to take based on this? If you noticed that you overplanned your revenue, and you thought you had revenue expectations that were too high for a particular month, you might have to look at where is it that you can cut costs, particularly if the cut or the downturn in revenue is more permanent, right? So basically what it does, it sort of gives you a picture each month of where you were expected to be versus where you are now, and it gives you sort of a course of action. You can see, okay, and vice versa on expenses, right? If you planned inventory with a certain amount or merchandise with a certain amount, and you notice that throughout the year those expenses are much higher than what you've anticipated, then you're going to have to look and see, okay, is there any way I can maybe increase the price, and so on and so forth. Okay. So basically what we look at the projections out of our plans versus those actuals, and we look at those differences. We have to analyze them, and then we can use this as a course for action. And obviously those plans that we make at the beginning of the year can also be our budgets, right? We know exactly how much we could technically spend on merchandise or on wages and salaries and so on and so forth. And when we can look throughout the year, then are we meeting those expectations? All right, and finally, how should you do financial reporting? Well, you can obviously prepare these statements by hand or Excel, but it's much better to use accounting software. QuickBooks, for instance, I have not worked with SoloBooks or FreshBooks, but I know QuickBooks lets you generate those on the push of a button. You can also set up budgets. You can put in plan data. So the preparation of those is best done by some kind of accounting software. And I also recommend, to have them prepared by a bookkeeper or an accountant. So for you, you basically get those statements when they're already done, and you can look at them and sort of derive what kind of next action you have to do it, instead of having to sit there and actually prepare them from yourself. Because if your books are in a good shape, right, those statements come at the push of a button at the end of each month or at the end of each reporting period. All right. So that's all I have for today. I'm happy to answer questions.
Great. We do have some questions. I'm also bringing in Debbie Dobbins from East Cambridge Bank. So if you have any questions for her, please put those in Q&A as well. So can the debt be what the owner has paid from their own money, or are you only talking about debt to a third party?
So, so the answer is yes, it technically can be, but that's so you could technically, as an owner, extend debt to your company, right? So you can make a loan to your company as the owner, right? That's possible. But typically, what we look at in debt, right, is what, for instance, a bank loan that's extended to us. If it's bigger corporations, any kind of bonds that they issue, that is what we call long-term and interest-bearing debt. So you're going to have to pay some kind of interest payment on that debt, right? From a third party. We can also have what's called short-term debt. That is, for instance, if you have some kind of short-term credit line, or if you have some kind of trade credit that's extended to you. So it's typically from like a third party, but that's not to say, as the owner of a company, right? If you are an owner of your company, you have the equity of your company, right? You hold the equity of your company, but you could technically also go ahead and use personal assets, your personal cash, right? And extend a loan to your company. And the details on that are left to the accountants, because I know that there are some kind of rules with regards to taxes.
What is a good profit margin?
A good profit margin is that's a good question. There is no I guess, universal answer to that. What I would suggest is basically looking at how your profit margin changed over time. And if you can get some data from the industry that you're working in, sometimes there are some industry associations that kind of show you how profitable, what the profit margins, the typical profit margins that you would expect for a company in your certain area of business to be. So there's no universal answer what makes a good profit margin, but you could think about it this way, right? So you can look at the net income, right, or look at the profit versus your sales, and then think about, okay, so I made $1 in sales, how much does actually trickle through into profit? So if I make 10 cents on every dollar, that's probably not too bad. If I make 1 cent on every dollar, I mean, I still make a profit, right? I don't make a loss, but I might want to, try and get that up somehow, right? Either increase my revenue or get my expenses down. But it's very dependent on the industries. There are some industries out there where 6% or 5% profit margin is considered great.
Okay. And this question, I believe, came back from when you were working on cash flow. Why is depreciation added in?
Well, depreciation, right, is not a cash outflow. So if you think about this, when you let's just say you purchase furniture, right, for your store or some kind of other equipment, cash register, right? Typically what's happening is you acquire this cash register, right? It costs you $5,000 or $10,000, right? That's when your cash outflow happens, right? So that's when you lose all your cash for this. That $10,000 goes out when you purchase your cash register. But accounting actually asks you to sort of match the life of your cash register, right, over the time or the usage sort of over time. So in other words, the accounting rules tell you that you cannot expense a cash register that you're going to use for example for 5 years of for the full amount, right? In the year or in the period that you purchase this, you actually have to depreciate to account for this usage. So in our case, right, let's say we purchase a cash register for 10,000, we use it for 5 years. That means we have to depreciate it for each year for $5,000. Sorry, for $2,000. So 10 divided by 5, right, is $2,000. Those $2,000, when you think back to our profit and loss statement, are an expense, right? It was revenue and expenses, and those included the depreciation, right? So that was accounted for in the net income, but cash didn't really flow, right? For those $2,000, because the cash for those $2,000, matter of fact, the entire $10,000 flew when you actually purchased it, right? So that is why, long-winded answer to short question, you have to add depreciation because it's not a cash outflow in the period.
I have a really good question. What advice would you give for a company that started and didn't organize all of this information? What would you say are the best action steps to take, considering the company is new and didn't make any profit?
So my advice would be twofold, right? So I would suggest to find somebody, and I know that this is, especially in the startup phase, right, difficult to do because it's, it is an expense. But I would always advise to see if you can find a bookkeeper that can work with you on getting those books or those your business transactions actually organized, because not only is it important to sort of get a deeper understanding on why you did not make any profit, you're also going to have to file taxes eventually, and when you file taxes, you're going to have that information. So my best advice would be to find somebody that can work with you on organizing this. And it might seem overwhelmingly at first. And again, I don't know the size of the business and I don't know the transactions, but a lot of times this can be organized fairly quickly, because a typical business will have repetitive transactions, right? It will not, there might be some startup transactions, but then you might have repetitive transactions, right? You always pay wages, you always purchase inventory, and you might even purchase them from the same vendor. You always pay utilities, you always pay rent. So it might seem like this big mountain in the beginning, but I think it can be chopped down. But it needs to help, in my opinion, of like an accountant or a bookkeeper that can help, like sort of help you break those break it in individual steps. Or you can also reach out to the SCORE mentors, and they can maybe work with you in a little more detail on which directions you should go.
Debbie, are you by chance there?
I am. Can you hear me?
Yeah, we can. Would
Great.
you like to give a little intro before we do our last question?
Sure. I can tell you a little bit about the bank and just tell you what I would like to underscore is how important. So you can hear me, but you can't see me?
Yeah, I'm not sure why, but yes, we can hear you.
Something on my end. Well, it probably has to do with how I was set up. Because I don't see that I have the ability to change the camera, but you know what? I am fine not being on the camera. Oh, wait a second. Here we go. Join as a panelist.
Oh, now you're muted.
Okay. And now I'm on camera.
Yes.
I wouldn't know what the camera looked like. Okay. So I just want to underscore what everything Nicole said is so important. And for some people, getting a handle on the financials is the hard part. And what I would say is, if you're feeling that way about it, don't hide from the numbers. Find somebody at SCORE to help you. Find a bookkeeper because it's really critical to you understanding your business and for what a lot of companies want to become, which is what we would call bankable. So you need to be able to show a good financials. But just to tell you really quickly about East Cambridge Savings Bank, we are a lender. We lend to small to medium-sized businesses. We were established in 1854. We're a mutually owned bank, so we don't have stockholders. And this makes it really more easier for us to focus on our communities, our customers, and our employees. And we've served the community of East Cambridge and beyond, as I said, for over 150 years, over 160 years. We have 11 branches, and as of December 31st, our total assets were $1.3 billion. And we take great pride in being part of the communities in which we operate, and would spend countless hours volunteering in these communities. So thank you for joining SCORE and us for this. And please, hopefully somebody can pass out my name and number and Johnny Long's. And we're happy to take your questions and play a consultative role if that's helpful to you.
Yeah, great. Yeah, we will be sending out a follow-up email to everyone today with information on how to get a SCORE mentor, how to reach out to East Cambridge Bank, and the recording for today's webinar. I think we're going to have to wrap it for today. We're at 1 o'clock. I just want to thank Nicole and the Northeastern chapter for giving this presentation for us, and for East Cambridge Bank for bringing this series together for SCORE to give. So have a great week, everybody. Thank you.
Lisa. You too. Bye. Thanks, Nicole.